Hello and welcome to Making Sense of Markets, Quarter 1, 2016. My name is Sheldon McFarland, Vice President of Portfolio Strategy and Research at Loring Ward. With me today is Matthew Carvalho, Director of Investment Research at Loring Ward. Investors faced a number of concerns right off the bat this year. The first 6 weeks saw the worst start to the S&P 500 on record. International stocks plummeted as well on the heels of fresh slowdown worries around much of the world. Oil continued to plunge, down 40% at one point from an already low starting point, and a contentious election primary season added to uncertainty in the markets.
Certainly the case that it felt like all these factors were converging on investors at once, and that made it really easy to fall prey to some of the more inflammatory headlines out there, such as this one, which painted the picture of the stock market going up in flames. But like most quarters, pundit predictions proliferated market headlines. And when we look at the U.S. stock market performance, we wanted to address some of the concerns, some of the headlines that we saw during the time period. And so if we show the stock market starting to fall at the beginning of the year, on January 7th, we heard from legendary investor George Soros that it's the 2008 crisis all over again. Just a few days later, we heard that we should be preparing for stocks to fall yet another 10% from their new lows they had just created. And in early February, we got some pretty drastic news from Citibank saying that the world economy was trapped in a death spiral. And perhaps most worrisome, on February 11th, the Royal Bank of Scotland issued a report saying that investors should sell everything. Now, the stock market was down about 10% at this point, and we should mention that the experience in other stock markets around the globe was pretty similar. Yet, as we discussed last quarter, we've historically experienced a 10% decline at some point on average during every calendar year. So this 10% decline on the S&P 500 was notable only because it came so rapidly at the start of the year. However, that Royal Bank of Scotland report happened to be on the low point during the quarter, and as the market started to recover, so did sentiment, and by the end of the quarter, we had pundits predicting all-time market highs were right around the corner.
Succumbing to the headlines would have been a textbook example of how not to make money investing. Short-term predictions about the stock market are often worth less than the paper they're printed on, or these days, the pixels.
But we should mention there was one prediction that was spot on, and that came on January 1st from the Associated Press with the headline, "Expect Less and Buy Antacid." Looking backwards, that was pretty apt advice to daily market spectators. However, if you took a 3-month vacation and hadn't checked your balance, you would have returned thinking the first quarter was quite normal. No antacid was needed.
And how about interest rates? For many years, there have been concerns over hyperinflation from the large amount of government bailouts. Then there were concerns that rates would spike following possible credit rating downgrades. Most recently, it's been the specter of successive Fed rate hikes, which would finally drive rates up. That certainly was a concern coming into 2016, following the initial rate hike in late 2015. Most analysts forecasted 4 or more hikes in 2016, with rates increasing throughout the year. Yet as the first quarter came and went, we saw rates fall both domestically and internationally, with the Bank of Japan issuing bonds at negative interest rates, investors literally paying the government to hold their money. By March, predictions had succumbed to the reality of fewer rate hikes this year. What seemed obvious and apparent, at least to the Wall Street experts at the beginning of the year, never came to fruition.
And this isn't a recent phenomenon. In fact, we looked back at the last several years of Wall Street expert forecasts and found that consistently higher rates were expected, but had not materialized. On this chart, we're looking at the yield on a 10-year U.S. Treasury bond, and we see that since 2014, it's certainly been declining. But if we think back to that January of 2014 and look at what the expectations were for that year, well, we can see that the consensus was for rates to rise to somewhere around 3.4% by the time the year had ended. But in fact, interest rates went in the exact opposite direction and continued to fall, ending the year in the low 2% range. In 2015, again, similar concept here where rates were expected to rise, Expectations were for the yield on the 10-year Treasury to end the year around 3%, but in fact we saw interest rates end the year basically right where they started, not having increased at all. Going into 2016, again, the idea was for rates to rise again. Maybe this would finally be the year that interest rates climb. The expectation was for 2.7% yield on the 10-year Treasury, but in fact, to start off the year, we've seen interest rates go in the exact opposite direction again, falling by nearly 0.5% in the first quarter of this year. Now, to me, this is really just further proof that trying to predict the future is a fruitless exercise. At some point, we are likely to see higher interest rates, but we just don't know if that's going to be later this year or perhaps not till later this decade. Understanding and being comfortable with your level of interest rate exposure is far more useful than trying to guess which way interest rates are headed.
Now let's look at exchange rates, which also play a pivotal role in the value of your portfolio. Looking back the last 5 years, we've seen a considerable increase in the value of the US dollar compared to a basket of world currencies. As the US dollar rises, the value of those foreign investments falls, and vice versa. Predictions for 2016 were more of the same, with forecasted Fed rate hikes and a relatively strong economy. Continued strength in the US dollar appeared inevitable. Yet when we look back at exchange rates for the most recent quarter, we see a significant reversal, a fall in the value of the US dollar relative to other currencies of nearly 5%.
Now, we've discussed the impact of exchange rates in some previous webinars, but we thought it'd be going through another very simple illustration of how changes in exchange rates impact your investments. So, for example, if you had made a $100,000 investment in a Japanese stock on January 1st of this year, let's use Sony for example, it was worth roughly 12 million yen on that date. Now, if the company's share price remained the same during the quarter, which is pretty close to what Sony actually experienced, then the value of the investment at the end of the quarter would be roughly worth the same amount when priced in yen. However, because the value of the US dollar compared to the yen had changed during the quarter, the value that would show up on a March 31st statement for a US investor would show $107,000, a $7,000 gain simply because the yen had strengthened by 7% compared to the US dollar during the last quarter. Now, quarter to quarter, this is always going to have an impact on returns. Sometimes it'll help, sometimes it'll hurt. However, over the long term, it generally nets out, and the bigger determination of returns is going to be the performance of that underlying company that you're investing in. But during periods like what we've seen the last couple of years, with relatively smaller stock market returns, the currency impact has been more noticeable.
And over the last 5 years, the dollar has strengthened by over 25%, which explains a significant amount of the difference in returns between domestic and international markets over that period. Now, this may have caused you to question if international holdings were still a good option for your portfolio.
Well, U.S. stocks have certainly outperformed their international counterparts most recently, but that's not always going to be the case. We don't have to look too far back to find a pretty long time period in which international stocks actually outperformed U.S. stocks. In fact, if we look at the 10-year time period just before this, we see that the international outperformed by nearly the amount they had underperformed more recently. And when we start to think back to the mid-2000s, we can start to remember themes like the lost decade. And that was the discussion of the U.S. market going nowhere for the entire 2000s. I went back and looked through some of the headlines during that period and found some of them pretty remarkable. For example, in January of 2007, a point when international securities had been doing fantastic. Had you been reading the USA Today, you would have noticed headlines such as U.S. investors send their cash packing, investors flooded international stock funds, or perhaps most confounding, the economies in Europe and Japan are growing faster than the U.S. Now, had you heeded that advice, you would have moved more of your assets to international markets right before they started to underperform the U.S.
Getting back to the most recent quarter, let's take a brief look at how a variety of asset classes performed. Easily the biggest surprise came with emerging markets, leading the way with nearly an 8% gain during the quarter, despite ongoing worries about China, Russia, and Brazil. A mix of 65% stocks and 35% bonds yielded a slightly positive return during the quarter.
Now, keeping those same asset classes in mind, if we look at the rankings of those annual asset class returns, it becomes pretty clear that the U.S. large asset class, as represented by the S&P 500, has done fairly well in recent times. As we can see here, between 2013 and 2015, it outperformed international stocks every single year. And that can easily lead to the behavioral finance concept of recency bias, simply the idea that what has performed well recently will continue to perform well into the future. Yet if we look back just slightly onto this chart, we run into that lost decade that we mentioned earlier, and we see that the US market has not always been the global leader in terms of performance. In fact, between 2003 and 2007, international stocks outperformed their US counterparts each of those 5 years. Now, maintaining a diversified asset mix, such as the 65% stock, 35% bond mix that we had also highlighted on this chart, has been able to keep you away from the most extreme returns and experience significantly less volatility over this time horizon. We wanted to take that same idea and extend it back even further, wanting to learn what a realistic range of outcomes was over a large variety of market conditions. Now, here's what we've seen historically. Over 1-year rolling periods, the range of returns can be quite large, even for a globally diversified portfolio. We're looking at a range of a gain from over 40% on the upside to a loss of worse than 30% on the downside. Now, that's a really huge range and makes any type of planning for the future next to impossible. However, the longer that you held that portfolio, the narrower that range of outcomes became. And you can see this with the shrinking range of returns as the time period extends to the right. Historically, all 10 and 20-year periods have seen positive returns. This is why having a long-term time horizon is key to achieving your financial goals.
So in closing, we can't know what will happen in future periods, but if the past is any guide, the longer your time horizon, the more likely you are to capture long-term rates of return. Thank you for joining us. We look forward to having you listen in again next quarter. Watch for the next recording to be available in July.